Close your eyes for a second and picture the stock market right now in early 2025. Everything's breaking records. Tech stocks are going absolutely vertical. And there's one thing, one single word, that's driving this entire insane rally: artificial intelligence. Nvidia's stock price has gone up 4 times in just 3 years. Microsoft's market cap just blew past $3 trillion, and AI startups that literally nobody outside Silicon Valley has heard of are raising billions at valuations that make even the greediest venture capitalists uncomfortable. It feels like we're witnessing the birth of the future. It feels unstoppable. But here's what almost no one is seeing. Under all that excitement, under all that hype, and those soaring valuations, there's a pattern taking shape. And it's a pattern I recognize. I watched this exact same pattern destroy people's fortunes back in 2000 when the dot-com bubble imploded and the NASDAQ crashed nearly 80%. The difference this time, the money isn't just flooding into AI companies, it's moving in a circle. The same capital is showing up on multiple balance sheets as revenue. The same hardware is being financed and then repurchased by companies that are partially owned subsidiaries. This isn't a technological revolution, it's a financial Ouroboros, a snake eating its own tail, and when you actually run the numbers, none of it makes sense. Let me walk you through exactly how this works. A massive chip manufacturer, let's say Nvidia, invests billions of dollars into a small AI startup. That startup then takes that exact same cash and uses it to buy chips back from Nvidia. Nvidia records this as revenue and growth, which sends their stock price to the moon. But here's the fundamental problem. No actual value was created. The money just moved in a circle. This practice has a name. It's called round tripping, and it was at the center of multiple massive scandals during the dot-com era. Companies like Enron and WorldCom used these exact same tricks to dazzle Wall Street before they collapsed literally overnight. Today, we're watching it happen again. But the scale makes the 1990s look like child's play. Nvidia recently proposed a $100 billion pledge to support OpenAI's data center expansion. Sounds massive and impressive, right? Except OpenAI is going to use that capital to purchase Nvidia's hardware. The money flows out as an investment and immediately flows back as revenue. Microsoft has invested $13.8 billion in OpenAI and now holds 49% of its for-profit entity. In return, OpenAI has agreed to purchase up to $250 billion of Azure cloud capacity through 2032. That's $250 billion flowing right back to Microsoft. Amazon committed up to $8 billion to Anthropic. Then Microsoft and Nvidia agreed to invest another $15 billion, $5 billion from Microsoft, $10 billion from Nvidia. In exchange, Anthropic commits to purchase $30 billion of Azure compute running on Nvidia systems. Do you see how tangled this is getting? And here's the most blatant example. Elon Musk's xAI is structuring a $20 billion special purpose vehicle that will buy Nvidia GPUs and then lease them back to xAI. Nvidia is reportedly contributing $2 billion of equity to that same vehicle while also supplying the hardware. They're effectively financing a portion of their own future sales. Venture capitalist Chamath Palihapitiya called this ecosystem a financial Ouroboros. That's not exaggeration or hyperbole. It's an accurate description of what's actually happening. Now, if you look at these deals individually, they appear commercially rational, make sense on paper. But when you add them all up across the entire industry, they reveal something deeply troubling. The same capital is appearing on multiple balance sheets as revenue. Growth that looks explosive on the surface but is largely internal to the ecosystem rather than being driven by actual external customers or genuine economic value creation. Financial firms, especially the global systemically important banks, have started flagging these circular arrangements as concerning. They recognize that when suppliers finance their clients, share ownership stakes, and split revenues, the interconnected nature can inflate demand signals, distort revenue metrics, and hide underlying vulnerabilities. And that brings us to the second major warning sign, because here's what nobody in the mainstream financial media is talking about. These AI companies are burning through cash at rates that are completely unprecedented in technology history. OpenAI provides the most shocking example. According to Microsoft's own financial filings, OpenAI lost more than $11.5 billion in a single quarter. That's an annualized cash burn rate of approximately $46 billion per year. This isn't some controversial estimate or conspiracy theory, it's straightforward division from public filings. OpenAI now spends $3.30 for every single dollar it earns. Deutsche Bank projects $143 billion in cumulative negative free cash flow through 2029. The analyst specifically noted that no startup in history has operated with losses on anything even close to approaching this scale. We are firmly in completely uncharted territory. Let me simplify why this is happening. OpenAI trains its models on Nvidia GPUs that are accessed through Microsoft Azure cloud infrastructure. Every single time someone uses ChatGPT, OpenAI pays Nvidia's margin, plus Microsoft's margin, plus its own operating costs. It's like paying rent to 3 different landlords just to open your store every morning. Now compare that to Google. Google trains Gemini entirely on its own tensor processing units. No external GPU purchases, no cloud provider margins stacked on top. According to semiconductor research firm SemiAnalysis, Google's TPU infrastructure delivers 30 to 44% lower total cost of ownership than Nvidia's systems. This cost gap isn't temporary, it's structural, and it gets wider with scale because every additional query that OpenAI serves multiplies that margin disadvantage. The market is starting to notice. Gemini reached 650 million monthly active users in Q3 2025, while ChatGPT's US traffic declined 35% in November 2025. Mark Benioff, the Salesforce CEO who had used ChatGPT daily for 3 years, posted to his 3.2 million followers, quote, "I'm not going back, and it's not just OpenAI bleeding money." CoreWeave, the infrastructure company providing GPU access to various customers, ended Q3 2025 with $14 billion in debt. Their unsecured senior notes carry a steep 9% interest rate. The company projects a $1.09 billion net loss for 2025. CoreWeave stock has crashed from peaks above $180 down to below $70. The market has begun pricing an execution risk and the very real possibility that these companies cannot service their debt loads if infrastructure utilization or pricing declines. The fundamental issue is this: AI companies require extraordinary compute resources to train and serve their models, and these resources cost vastly more money than current customers are willing to pay. The solution so far has been to have investors provide the capital, either directly as equity investments or indirectly through cloud provider commitments to purchase infrastructure. But this solution only works if the end customers for AI services eventually generate enough revenue to justify the infrastructure costs. If they don't, the entire structure becomes completely unsustainable. Now here's where things get really interesting. And by interesting, I mean deeply, deeply concerning. There's another critical issue that's emerged: accounting practices that systematically overstate hyperscaler earnings, what some analysts are calling a $176 billion depreciation arbitrage. Phantom earnings that disappear when you apply realistic depreciation schedules. Let me break this down. Traditional servers were historically depreciated over 3-year periods. In January 2020, Amazon changed the depreciation schedule for its server assets from 3 years to 4 years. By 2023, all 3 major hyperscalers, Amazon, Microsoft, and Google, had normalized on 6-year depreciation schedules for their infrastructure assets. This extension from 3 to 6 years has a massive impact on reported earnings because companies can spread the same capital expenditure over twice the time period. This reduces their annual depreciation expense and thereby improves their reported net income. But in January 2025, Amazon made a striking reversal. The company shortened the useful life for servers supporting artificial intelligence and machine learning workloads from 6 years back to 5 years. In their disclosure, Amazon explicitly cited the pace of change with respect to AI and ML technology as justification. This was an explicit acknowledgement that AI hardware becomes obsolete faster than general-purpose infrastructure because each new GPU generation renders prior generations economically uncompetitive. The accounting impact was immediate: $700 million in additional annual depreciation expense, reducing net income by approximately $298 million per quarter. Yet here's the deeply troubling part. Amazon's action demonstrated that GPU hardware depreciates faster than previously assumed, but the other hyperscalers have not made similar adjustments. This means that the same assets, identical GPU hardware, receive dramatically different accounting treatment on different companies' balance sheets. And the secondary market for GPU capacity tells us that even 5-year assumptions are wildly optimistic. GPU cloud rental rates have collapsed from approximately $8 per hour for H100 equivalents in early 2024 to approximately $2.10 per hour by late 2025. That's a decline exceeding 70% in under 2 years. Princeton's Center for Information Technology Policy published research documenting that GPU hardware is being essentially given away in certain hosting arrangements. Providers are prioritizing utilization over pricing just to maintain competitive positioning. Multiple cloud providers are offering H100 capacity at rates below their own cost of capital. They're accepting losses just to maintain market position. This behavior is completely consistent with hardware whose economic value is declining faster than accounting useful lives recognize. According to analysts like Michael Burry and others, the depreciation arbitrage, that gap between accelerated and extended depreciation schedules applied to identical hardware, creates phantom earnings exceeding $50 billion annually across the hyperscaler complex. The cumulative impact through 2028 could reach $176 billion. If hyperscalers were forced to use realistic depreciation schedules that actually reflect the economic life of GPU hardware, their reported earnings would decline substantially. This would potentially eliminate the profit growth that justifies their elevated valuations and continued massive capital expenditure. Now you might be thinking, okay, but this is just growing pains. Eventually demand will catch up and justify all this spending. Let me show you exactly why that's extremely unlikely. In 2025, hyperscalers committed approximately $400 billion to capital expenditures. That's up 70% from 2024. Goldman Sachs Research expects this spending to continue increasing, with consensus estimates reaching $527 billion for 2026. To put that in perspective, AI infrastructure needs approximately $2 trillion in annual revenue by the end of the decade to justify the current and planned investment. That's an absolutely insane amount of money. Nobody has it, and nobody may ever have it. Here's the core problem. Big tech companies have large cash flows, but the trillions needed are too steep even for them. Venture capital isn't interested in funding infrastructure directly. So what's filled the gap? Private credit. The private credit market now manages close to $2 trillion in assets, representing 17% year-over-year growth. Much of the AI build-out is now being financed through complex private credit structures involving multiple lenders and syndicated arrangements. But here's the dangerous dynamic that's developing. GPU equipment is being used as collateral for loans that are financing the purchase of additional GPU equipment. If GPU prices decline, which they already have dramatically, or if utilization rates fall below projections, the collateral values evaporate while the debt obligations remain. And then there's the physical constraint that absolutely nobody is talking about: power. Hyperscale data centers operating at 100 megawatts or more are becoming standard. A single 1 gigawatt data center requires approximately $10 billion in construction costs and another $20 billion in GPU equipment costs, and it consumes energy equivalent to that used by 700,000 homes. To meet projected AI compute demand, the United States needs to build 75 to 100 gigawatts of new generation capacity by 2030. But new power generation facilities typically require 3 to 5 years of construction. Data centers are being built on schedules of 2 to 3 years. This is a dangerous mismatch where demand for power capacity has completely outpaced the grid's ability to provide it. Researchers at Carnegie Mellon University warned that heavy concentrations of data centers could push residential electricity bills up as much as 25% in some regions. The power grid constraint creates a hard ceiling on how much AI infrastructure can actually be deployed. Unlike capital, which can theoretically be raised in unlimited quantities, electricity generation capacity requires physical construction that cannot be accelerated indefinitely. If AI infrastructure deployment hits this physical constraint before end customer demand materializes, the entire structure faces collapse. And here's the most telling sign of all. The smartest money in the room is starting to quietly sell. In November 2025, Peter Thiel's hedge fund sold off its entire holdings in Nvidia. This is the venture capitalist and PayPal founder who famously bet big on technology trends early. The timing was significant, coming as Nvidia itself was facing margin compression pressure from rising input costs. SoftBank, which had been one of the most bullish investors on AI, experienced dramatic stock volatility despite posting a $19 billion gain in its vision fund related to rising AI valuations. The market wiped out nearly $50 billion in market cap as AI bubble fears gripped investors. Google DeepMind CEO Demis Hassabis issued a stark warning in late 2025, suggesting that many startups are riding a bubble that could soon burst. Coming from the head of one of the world's most advanced AI research laboratories, this warning carried particular weight. While some continued promoting AI investments publicly, the private actions by sophisticated insiders, those with access to actual financial statements and strategic information, indicated growing caution about the sustainability of current trends. The pattern is absolutely undeniable. During the Dotcom crash, which peaked on March 10, 2000, the Nasdaq fell 78%, wiping out $1.75 trillion in value. The telecommunications crash that followed in 2001 was even more severe, with companies owing $1 trillion in debt, much of which was never repaid according to Federal Communications Commission testimony. But this AI infrastructure bubble could be worse. The financing is increasingly reliant on private credit and leverage, not just equity. The interconnectedness of hyperscaler balance sheets means that problems at one company could ripple through the entire ecosystem like dominoes falling. And the circular financing mechanisms mean that the same capital appears on multiple balance sheets as revenue, completely obscuring the true scale of leverage embedded in the system. When these arrangements unwind, when AI startups stop purchasing hardware from their investors, the revenue evaporates across the entire chain. Companies simultaneously face both revenue declines and collateral impairments. It's not a question of if this happens, it's a question of when. The most likely scenario is not an immediate dramatic collapse, but a grinding compression where the profitability gap between AI infrastructure build-out and actual end customer demand gradually narrows the viability of ongoing expansion. This could unfold over 18 to 36 months, creating enormous losses for late entrants who bought at the peak. Now, I'm not a financial advisor, but these are the things I'd be focusing on if I were you. First, recognize that we're in the late stages of a cycle that's being driven by circular financing, not genuine end customer demand. When vendor financing unwinds, valuations compress rapidly and violently. Second, pay very close attention to depreciation schedules in financial statements. Companies still using 6-year assumptions for GPU hardware are overstating their earnings. That's not an opinion, that's mathematics. Third, watch insider behavior more closely than public statements. When sophisticated investors like Peter Thiel exit positions while still promoting them publicly, that's a signal worth paying attention to. This is exactly why my friends lost millions during the dot-com crash while I kept investing strategically through the downturn. I focused on companies with genuine business models and real revenue, not circular revenue loops and accounting tricks. Make sure to subscribe if you want to grow your wealth and actually understand the patterns that separate real sustainable growth from financial illusion. I'll see you in the next one.